In today's video, I'm going to show you all the different types of taxes that you pay so you have a firm grasp on where your money is going, at what rate, and at what time.
Where's all your money gone, Daddy?
Taxes.
It's okay. It's part of the game.
No, it's not.
I'm Raul Shah. I'm the CEO of Doc Shah Financial. We're a wealth management practice that works with retirees on making sure that they do not pay more in taxes than they need to. We use a lot of different advanced tax planning strategies, and I'm going to show you slides from a tax planning course that I taught for Johns Hopkins University, which is also my alma mater. So let's go ahead and jump right in. What are the different types of taxes and how do they apply? So the first one on the left here that you'll see is our federal income tax. Okay, we are very familiar with this tax. Everything that you make, all your W-2 income, is going to be subject to federal income tax. It is a direct tax that is levied on your income. You cannot avoid it. Now, federal tax brackets are progressive, which means that they increase as your income increases. They range from 10% all the way up to 37% for high earners. It depends if you file your taxes as single or if you file them as married filing jointly. Married filing jointly tax brackets are double the size of single tax brackets. And we'll put a little overlay here so you can actually see the progressive nature of federal income tax. That's the first and main type of tax that you are likely subject to. The second type of tax that is similar is your state and local income tax. So most states will also tax your income the same way that your income is taxed at the federal level. But at the state level, it's generally speaking much smaller. You do not have 37% tax brackets at the state level. Now, some states like Florida and Texas, they don't have any state income tax as of 2026. Some states like Maryland will have not only a state income tax, but they'll also have a local or county income tax. So those tax rates can add up very quickly. Someone who's making $1 million could be subject to 37% marginal tax brackets, maybe 6.5% in Maryland, and then maybe another 3.5% at the local level in Maryland. And it could add up to almost 50% in taxes. And that's not including the next type of tax that we're going to talk about, which is FICA tax. Now, FICA tax are the taxes for Social Security and Medicare, and they are taken out of your paycheck, and they come on both sides of the coin. So, for example, when you get your paycheck, you'll actually see a deduction for Social Security and for Medicare. Now, Social Security has a limit. If you make over about $184,000 in 2026, you won't get subject to Social Security tax beyond that. But beneath that, you will pay. And the amount that you're going to pay is going to be 6.2%. But remember, there's two sides of this coin. Your employer actually pays the other 6.2% for a total of 12.4% in Social Security tax. Now, out of your paycheck, you also pay a Medicare tax, which you can see here is 1.45% taken out of your paycheck, and the employer also pays 1.45%, which is a total of 2.9%. Now, there's an additional Medicare tax for high earners, which is 0.9%, but we won't worry about that right now. I just want to explain the concepts to you. So when we add both of these up, we're looking at about 15.3% in FICA taxes. Now, half of that, 7.65%, is what you pay, comes right out of your paycheck. You don't really need to do anything, but you'll see it deducted. The other 7.65%, the employer sends straight to the IRS. So you can include that in your taxes because that's money you would have likely otherwise gotten. It just never crossed your hands. It wasn't what we call found money. It was just sent directly to the IRS, but it's still a tax because it's coming out of what would have been your income. Now, some people will debate this because they say it's counterfactual. It's not found money. Regardless of how you look at it, FICA taxes are 15.3%. Now combine, right, your ordinary income tax, which includes your federal income tax, your state local income tax, and your FICA taxes, which is your Social Security and Medicare. These are taxes placed on your income. They are just levied on your income, and they're taken out of your paycheck, or you ultimately make those tax payments come April or throughout the year as quarterly estimated payments. Now, if we move to the right side here, we've got capital gains tax. That is a different type of tax entirely. Okay, so if you think the tax system is confusing, it's only going to get a lot more confusing from here.
But wait, there's more.
Capital gains tax comes in two flavors. It comes in long-term capital gains tax, which ranges from 0% up to 20%. These are taxes that are paid on profits of assets held longer than 1 year. If you hold an asset for 1 year, exactly 365 days, it does not qualify for long-term capital gains tax. It has to be over, so 366 days or more. If your asset was held for 1 year or less, the gain on that asset when sold is subject to short-term capital gains tax, which is just taxed at your ordinary income level. So there's no special taxation rate as there is for long-term capital gains tax. So let's use an example. Let's say I have a brokerage account and I have $100,000 in a stock, and that stock goes to $200,000 over the span of 366 days. Great, it's more than 1 year, and if I sell it, depending on my other income, it will be subject to the long-term capital gains tax bracket. For most people, that's going to be about 15%. If I sold that stock on 365 days or less, it would be taxed at my ordinary income rate. So if my marginal tax rate based on my W-2 income is 24%, well, then I would pay 24% tax on that gain. So you can see there's a big discrepancy between long-term capital gains and short-term capital gains. And this is done to incentivize you to hold investments for the long term, right? We don't want to be buying and selling and flipping stocks and doing all that kind of stuff. You'll get results that are garbage when you do things like that. We want to buy quality assets and hold them for long periods of time. And that's something that I do for clients all the time at Dockshaw Financial. And this is something that we also do for clients, which is walk them through all of the different taxes that apply to them and in what kind of dosage, if you will. Now, we've also got property and estate tax. So property tax is an annual or local tax on the assessed value of real estate. We've also got the estate tax, which is very oppressive. It's 40% on estates over $15 million per person. One thing that people get confused with is the gift tax. The gift tax is not really a tax unless it's over your lifetime exemption of $15 million. And this is a topic for a separate video. But you've got property tax, estate tax, and then capital gains tax, which are all just taxes placed on your gains in property, as opposed to the left side, which are taxes placed on your income. So you can kind of see now how all these taxes are kind of working with each other. Now, if we go to the far right, we've got a few miscellaneous tax that I thought I would mention. We've got the NIT tax, which is the net investment income tax. Now, depending on your income, for certain high earners, if you have a very large capital gain, it could also be subject to a 3.8% surtax. So it could take the capital gains rate from 20% to 23.8% potentially. Social Security benefits tax. So Social Security is also taxed. Up to 85% of your Social Security could be included in your taxable income. It goes from 0 to 50 to 85. Those are the three general tax brackets for Social Security taxation. And it's a completely different tax calculation, by the way. It's a good separate video. If you want to see that, subscribe. I'll make it in the future. And then we've got the inflationary tax. Inflation is a tax. If prices go up by 5% in a year, well, that is a tax on your income. If you have $100, you only have $95 now. So however you want to conceptualize it, at the end of the day, it's a tax on your income because your purchasing power has been reduced. So there you guys have it. These are all the taxes that you are likely familiar with and that you will likely wind up paying in some way, shape, or form in your lifetime. If you're curious about how I manage retirement portfolios for clients, how we help retirees significantly reduce the impacts of all of these taxes, shoot me an email, raul@dockshawfinancial.com. I'd love to hear from you and your personal situation and how I can help. Otherwise, subscribe, and I'll see you in the next video. Take care.